Hello. My name is Montague William III. And what I will tell you may well sound absurd, but the less who believe it, the better for me. For you see, I'm in banking and a big industry. For many a year we have controlled your lives, while you all just struggle and suffer in strife. We created the things that you don't really need, your sports cars and fashions and plasma TVs. I remember it clearly how all this begun. Family secrets from father to son, inherited knowledge that gives me the edge, while you people lie sleeping at night in your beds. We control the money that controls your lives, whilst you worship false idols and wouldn't think twice about selling your souls for a place in the sun. These things that won't matter when your time is done. But as long as they're there to control the masses, I just sit back and consider my assets, safe in the knowledge that I have it all, while you common people are losing your jobs. You see, I just hold you in utter contempt. But the smile on my face, well, it makes me exempt. For I have the weapon of global TV, which gives us connection and invites empathy. You would really believe that we look out for you, while we bankers and brokers are only a few. But if you saw that, you'd take back the power. Hence, daily terrors to make you all cower. The panics, the crashes, the wars, and the illness that keep you from finding your spiritual wholeness. We rig the game, and we buy out both sides to keep you enslaved in your pitiful lives. So, go out and work as your body clock fades. And when it's all over, a few years from the grave, you'll look back on all this, and just then you'll see that your life was nothing, a mere fantasy. There are very few things that we don't now control. To have lawyers and police force was always a goal, doing our bidding while you march on the street. But they never realize that they're only just sheep. For real power resides in the hands of a few. You voted for parties. What more could you do? But what you don't know is they're one and the same. Old Gordon has passed good old David the reins, and you'll follow the leader who was put there by you. But your blood, it runs red, while our blood runs blue. But you simply don't see it's all part of the game. Another distraction, like money and fame. Get ready for wars in the name of the free, vaccinations for illness that will never be, the assault on your children's impressionable minds, and a microchipped world. You'll put up no fight. Information suppression will keep you in tow. Depopulation of peasants was always our goal. But eugenics was not what we hoped it would be. Oh yes, it was us that funded Nazis. But as long as we own all the media too, what's really happening does not concern you. So just go on watching your plasma TV, and the world will be run by the ones you can't see.
Welcome to our boot camp. You've made a great decision by being here today. Hi, I'm Dan Allen, and along with my colleague, Servlo Gill, we're going to provide you with over 2 hours of value. We'll show you how you can take control of the banking function as it relates to your needs. Here's what you can expect to see from us today. We're going to do an introduction to the process called becoming your own banker. Then we're going to give you clarity on how you can enhance anything you are presently doing when it comes to money. We're going to go through those 4 things that you can use money for. 1, you can spend it. 2, you can save it. 3, you can invest it. And 4, you can give it away. And wouldn't all those things be, better if you had more money to do it with? So we're going to touch on those things. Next, we're going to get into a case study, and this is going to form a big part of our presentation today. And this case study is on a couple, Andy and Jackie, and it's how they redirected 100% of their annual expenses into a banking system, their own, and away from the commercial banks, putting them in total and absolute control over all their money. And just so you know, their annual expenses are over $100,000 per year. And then we're going to do a group Q&A. And I want you to stick around for that, because there's going to be a lot of value you get from that group Q&A, hearing what other people have for questions. And the answers are going to make a difference. But I am going to caution you. This presentation will give you an insight into a different way of thinking. So are you ready to discover a better way when it comes to enhancing your financial goals? Before we get started, I want to talk and build off of what Paul had shared about participation. So today, we're going to ask you to participate. And when we ask you a question, please put your comment or your answer in the chat box. So let's just test this out. And I know you already did this, but I just want to know, out of all of you that are attending today, who is here for the first time? This is something new to you. So if you are, just put an N in the chat box. And if you've been at these events before, put, just I've been here before. And if you are already practicing the process called becoming your own banker, just put BYOB in the chat box. So one of the things that we're going to do is we're going to, help encourage you to participate. Because I know from studying the learning cone that if you participate, you're going to retain more of what you heard today. So what we're going to do for one of my colleagues is going to keep track of who is the most active people in the chat box. And a gift from us, not, Servalo and I, we're going to provide a gift to the top 3 people who participate the most today. And that's going to be a copy of this book. And so I'll just expect you to participate at a high rate, and good luck. And I hope you are one of those 3 people that we get to provide this gift to. So with that, I'm going to start into the next part of our presentation. Now, if you haven't figured out today, we're going to talk a lot about banking and the process of banking. Well, you'll know it now. Banking is the most important business in the world. And without it, all business would come to a screeching halt. Now, I'm kind of surprised that Hollywood hasn't done a feature film on this, where what would it look like if money stopped moving in our world? Like, talk about chaos. What an opportunity to have some, Broadway kind of presentation on what that would look like, chaos. So whenever a business transaction takes place, money has to flow from one party to another in a relatively short period of time, or otherwise nothing happens. Can you imagine walking into a store and then walking out without doing some transaction, paying for what you took? Well, if you did, that's probably shoplifting. So in order for the system to work, we have to send and use money to pay for those goods that we buy. That flow of money must come from a source, a supply source, a reservoir. And that is essentially what the banking business is all about. Someone or some organization has control of a pool of money that can flow at a cost to meet some need. And when it comes to that pool of money, there's only one. That's right. There's only one pool of money in the world. The fact that this pool of money is managed by a number of institutions like banks, insurance companies, corporations, or individuals in various countries with, using different currencies is incidental. To argue otherwise would be equivalent to someone looking at the globe and observing, hey, well, the Amazon River in South America flows into the Atlantic, and commenting that this has nothing to do with the Indian Ocean on the other side of the globe. You and I know those oceans are all part of the same system. Think about it. About 75% of the Earth's surface is covered by water. Those oceans are all connected. Now we know the sun heats up water, and that results in evaporation, causing wind currents. Those currents takes the water vapors around the earth and it precipitates out in the form of rain, sleet, and snow. And somewhere along the way, it flows through you and me. And without it, we would die. But here's the key thing to remember. Where does it all end up? Right back in the oceans. Now, just so you know, the banking business is somewhat like that. Money flows from a pool controlled by someone through our hands to meet our needs. But at some point, it all ends up right back in the banking system. So what I want you to know, it's all a matter of how much of the banking function do you control as it relates to your needs. So I'm going to ask you a couple of thought-provoking kind of questions. So I just want you to pay attention to these next to you and think them through. Just think about this one. How much money have you earned just this year so far? So for each of us, that number is going to be different, but think about what it is that you've earned this year. Now I'm going to ask you this question. How much of that do you still have? Now just put a number. If you think you got 10%, put that in the chat. If you think you got it all, put that there. But just give me an idea of how much of that do you have now? Are we getting any responses on that one?
Yeah, Dan, we're getting 0, 15%, 20%, mostly zeros. Not enough, not sure, none.
All right. So we're all familiar with this, right? Money flows through our hands, but most of the times it's flowing away from us. It's going somewhere else. We're making all those payments. And I was always amazed in life as to, how little money I kept. So next, I just want to put this in perspective. I want you to even think bigger. If you think about all the money that you've earned up to this point in life, that's going to be a different number than we just talked about. And depending on what stage of life you're in, it's going to be different for everybody. But for you, what would that add up to? And then I'm going to ask you this question. Who did all the work to earn that money? Well, I think you and I both know who did the work. That's right. You did. Next, this is a really good question. Who got all your money? That's what I want you to think about. So who ended up with all your money? Well, here's a few ideas for you to consider. Well, we know the tax man takes a chunk. At one point when I was a T4 employee, it was a big chunk they got. So everybody's going to be different. But the tax man takes a good chunk of that money that comes into our lives. Now the banker, and God bless them, we're using their money, so we should pay for it. But they're charging us fees, they're charging us interest, they're getting a good chunk of our money. And then if you've invested in, Bay Street or Wall Street, they've got some of your money. So there's lots of ways. And then there's Servlo. Oh no, I didn't mean that Servlo got your money, but I mean, Servlo is now going to show you how to keep your money. So Servlo, over to you.
That's right, Dan. I didn't get anybody's money, but I'm going to show you how to keep their how they can keep their own money. Perfect. Dan, I'm just going to share my screen. If you can just confirm you can see it, okay?
Yep, I've got it.
Perfect. Thank you. All right. So here at Ascendant Financial, we've been serving clients for over 16 years now, both in Canada and the United States. And we've been coaching them on the implementation of the process of becoming a banker, the infinite banking concept. That's our niche. That's what we do. And as a team, and we have a team of over 50 team members, amazing team members. And as a team, we speak to about 3,000 people on the process of becoming a banker because the clients want to know how this can work for them, right? So as a team, we speak to about 3,000 people on this process every year. And when we get into some discussions about how we can add value to what they want to get accomplished using the process of becoming a banker, this is one important question that we ask them. And the question is, what specifically must happen in your life financially for you to look back 3 years from today and realize that you have made a significant progress financially? And this is the feedback that we get from our clients. So what they're saying to us is they want more of financial control. They want more of cash flow. They want more of liquid access to capital. They want more consistent growth of wealth. They want to increase their savings. They want to increase asset protection. They want to enhance the retirement plan, if possible, tax-free. And we're going to talk a lot about tax-free today. They want more of financial security. And they want to have predictable outcomes regarding money and wealth. And last but not the least, they want more of financial independence. So this is a good summary of what they say they want more of. On the right-hand side, I'm going to walk you through what they share with us that they want less of. They want less of loss of capital. They want less interest payments leaving their families. They want to reduce their tax burden. They want less financial surprises. They want less restrictions to access to capital. Imagine getting capital out from bank today. If you have a good chunk of capital inside a bank and you call them to request moving that capital somewhere else, think about what process you have to go through. It's not a pleasant experience. So they want less restriction to access capital because opportunities are going to strike. And when opportunities strike, they want to access the capital immediately without any questions. They want less interest rate risks. They want less exposure to market. They want they want to have more control, meaning they want to reduce their control. They want to reduce the loss of control that they presently have. They want lesser fees and penalties. And the last thing is they want less financial complications. So when you're looking at the list of what clients are sharing with us in terms of more of what they want and less of what they want, which of these objectives are not relevant to you? So share in the chat box, which of these objectives are not relevant to you? And if you can relate with all these objectives that I have shared with you, then we can help you. The process of becoming a banker can help you achieve all that. Now, here's a testimonial / feedback from one of the clients, Sandy Bard, and this is straight from our Google. You can check this up on our website, on Google links. So what she's saying is, count us among the many who wish they had heard about the infinite banking concept decades ago. We are in our 60s and are embarking upon our 6th year. So they're in 60s and they're 6th year in this process. And truthfully, we could not be happier. Our personal banking system has allowed us to finance our lifestyle free of the constraints of commercial banks. It has offered and continues to offer a means by which our future will be taken care of, no matter what that may hold. And because the product making all of this possible is life insurance, we have that benefit that will take care of survivors between us and subsequently our beneficiaries. We no longer have to be concerned with the temperamental market performance and other investments. Instead, we enjoy access to our funds when we want, repayment of loans on our terms, privacy, safety, guarantees, and favorable tax treatment. We have no fear of outliving our money as we have a retirement strategy in place that will be funded by our own personal banking system. So when I went through more of, less of, here's a testimonial that speaks to all that. And if you want to listen to live interview of Sandy Bard, you can hop onto Wealth Without Main Street podcast channel, YouTube channel, and then it's right there. And Roman, if I may ask you to just share a link in the chat. So when Roman shares that link, please don't click that link and start watching it right now. You want to click that and just save it to watch it later on, right? We don't want distractions. We want everybody to focus on the content today because you invested your time in. And anytime during this webinar, if you want to talk to a authorized IBC practitioner on how this process can work for you, whether it's in your business, whether it's personal, you can text the word schedule if you're in Canada to 780-809-4599, or if you're in the US, you can text the word schedule to 813-793-7921 and schedule a time that works best for you. There's no money required for the call. There's no commitment from either parties to proceed, but at least have a conversation on how this can work for you. Now, let's dive into the money problem. Now, I'm going to do one thing here, hide floating. Okay. The problem is never the problem. The problem is how we think about the problem. And this is a quote from our business coach, Dan Sullivan. He runs a very successful entrepreneurship coaching academy called Strategic Coach. And I love this quote. The problem is never the problem. The problem is how we think about the problem. And the problem in North America isn't so much what people don't know. The problem is what people think they know that just ain't so. So in the bottom left-hand side, let's just say this is you. You're thinking about something, and that thinking results in imagination. Imagination creates ideas. Ideas result in strategies. Strategies don't work if you don't take action. So action is required. Action creates outcome. And then outcome is not good or bad. It is just an outcome. And then the whole process starts again. It just goes back to thinking again. Everybody is focused on, okay, how I can make my outcome better. Well, the only way to make the outcome better is by fixing the thinking problem. You know, developing an ability to think is a whole different way of actually thinking, right? So if you want to fix your outcome, let's go to the source of where everything starts from, which is how you think. So everything begins with how you think. Now, Dan is going to walk us through a very fun thinking exercise. You're going to love this. Dan, back over to you.
All right. Thanks, Servo. I'll just get you to confirm that you can see my slide deck.
Yeah, I can see it.
All right. So part of what our intention today was for you to have fun. So we're going to walk you through some fun exercises. And one is about fun thinking exercise. So let's get ready to participate. Now I'm going to ask you this question. One way for a banker to earn profit is by charging interest on loans. Now, would you agree with that? I think we're all pretty familiar with that one, right? That bankers make money from charging us interest when we borrow money. So that's a good one. Now I'm going to ask you a little further question to build off of this. And this is one where I want you to put your answers in the chat box. When they lend money, is it their own money or is it your money? Those people that make deposits at the bank. So I'm going to get you to type A or B in the chat or leave a comment. So let's see what everybody thinks. Whose money is the banker lending?
One person says my money. There's another comment on my money, but a lot of people opting for B.
A lot of option for B. So that's exactly right. They don't use their money. They use the money that you or I put on deposit at their bank. That's exactly what they do. So here's another fun thinking exercise. I want you to guess how much extra the banker is making on your deposit. So we're gonna do a bit of a view of what it looks like for the banker. So this is the bank, and this is a deposit that you put on hand at the bank. So you've deposited $50,000 in this bank. Now the banker doesn't let that money sit still. Bankers realize that money in motion isn't worth nothing, so they put it to work right away. And one of the things they could do with it is lend it to someone to buy a house. Now, as soon as that person takes that money and pays it to whoever they bought that home from, that person puts the money right back in the bank. Now, I think we've talked about how one pool of money, and it may not be the same bank, but it's going back in to the banking system. Now, the bank's also going to take that money when it comes back, and they're going to lend it to someone to buy a car. And that person's going to, pay the dealership. The dealership's going to put money where? Well, right back in the bank. And you can see how this cycle goes. We're just looking at a few examples here. Money goes out, they lend it, and it comes back into the banking system. So what I thought I'd do is, let's look at the difference that the banker made compared to you. Remember now, you were getting 4% on your deposit. And then in this first case, they're getting 6%. So that's 2% more than you were. In the next case, it's 3% more than you were. And then 4% more and 8% more. So when we add that all up, that's 17%. The banker got 17% more than you did for your interest payment. So just want to remind you, this could be you. But now we're going to go on to talk about the spread. So 17%, and the banker is paying you 4%. Now I want to ask you this question. How much more is the banker making as compared to you? And we got 3 possible answers. 17%, 425%, or 13%. So now is your chance to put something in the chat box. What do you think? What do you think? How much more on a percentage basis did the banker make than you did?
We're getting a lot of B's. We have 13%. Someone put in, so 13%, 425% B's, C. So it's between B and C, but a lot of B's.
Okay. So we got a lot of sharp people watching today and paying attention to our boot camp here, because the answer is 425%. So if you just simply take 17% divided by 4%, you will get 425%. So that's how much of a better return they got on their money than you did. Doesn't mean, that's how banking works. And where did the banker, where did that money come from again, that the banker used to make that 425%? Well, I think you already know the answer to that question. It was yours. So in the chat box, I want you to list all the disadvantages of becoming a banker. So this might take a while, but hey, let's just start at it. I want you to list all the disadvantages of becoming a banker.
And one person said risk.
Risk?
None,
Okay.
very few, high stress, none, brick and mortar, startup, capital to start, marketing, none.
Yeah. So excellent. So there's different answers. If you think about starting up a commercial bank, it's going to take some time, but really a lot of you hit on none. And that's the one I think about, because really, there's not a lot of disadvantages other than the startup of a bank. It's really a great way to make a lot of money. And so with that, I'm going to turn it back over to Servlo, and he's going to walk us through the money problem. Servlo?
Thanks, Dan. All right, so let's continue with the money problem. I'm going to hide my annotator of meeting control. Perfect. All right, so I'm going to share today what our clients shared with us during our initial discussion. And then feel free to share in the chat if you feel the same. So here's what they say. We know that there is something wrong with the financial world out there, but we just can't pinpoint what's wrong. After working so hard, we are still not making financial progress. We are not where we should have been by now. Seems like we are working against a financial headwind, which is pushing us backward. Here's another testimonial from our Forbes. We had a tiny bit of money with one of the big name investment management groups for years. We worked hard, earned a decent income, and managed to stock away a tiny bit every month. Despite this, I always felt like a struggle, exactly what it described. This is what clients say. There's something wrong with the financial world out there. I just can't pinpoint what it is. So Ricas Forbes goes on and says, we decided to go all in and give this a try, which he's referring to the process of becoming a banker. For us, the benefits were immediate. We paid off a lot of debt way faster than we thought possible. And we found we had access to cash that we didn't have before. How important is access to cash for you today? These are just a couple of immediate benefits. The long-term benefits are just even more exciting. All of this without having to come up with a single penny extra over what we were spending. This is truly an amazing program. It's definitely not a quick get-rich scheme because it's a process. Banking is a process, not a product. You're not buying a product. You're implementing a process. This is about dedication, taking control over your dollars, and patience. Ricas did a fantastic interview on Wealth on Main Street. And Roman, if I may invite you to just share the link in the chat. Again, when you click on that link, don't watch it right now. Just save that link for future. One thing I would say on Wealth on Main Street is there's a playlist of client series, and then you can actually go through client series of a lot of clients sharing what they have experienced after implementing the process of becoming a banker. I think you will love it. So the only way to get out of financial prison is to clearly understand the problem. What is keeping you in it? That's a problem that you have to understand. And once you understand the problem, you can implement the right solution to not just get out of the financial prison, but also help you stay out of it permanently. Let's look at the situation together. So this is a client. So client, the names are Andy and Jackie. Obviously, to protect their privacy, we're not going to share their true names. But this is a client profile that we recently worked on. So client profile, Andy and Jackie. So Andy is 50 years young. Jackie is 45 years young. Andy's income is $180,000 per year. Jackie's income is $80,000 per year. So this is the active income. They have other sources of income. So they have some real estate properties, which produce about $6,000 in net cash flow income for them after covering all the mortgages and expenses. And in addition to that, by just nature of the jobs that they're in, they're entitled to some additional bonuses at the end of the year, which is about $20,000 to $25,000 per year. Andy is a CPA, so he's an accountant, and Jackie is a project control manager. And they have two sons at the age of 10 and 15. So this is a simple client profile. Now, you can do 4 things when it comes to money, and Dan touched on it, but I'm just going to revisit it. One thing is you can save it. So saving could be for emergency, for sickness. Saving could also be saving for buying a big ticket item like a car, down payment for a home, vacation funds, things like that. You can invest it so you can grow wealth, create passive income, real estate, stock market. There's so many ways that one can invest money. You can spend it. So spending could be on, mortgages, cars, vacation, property taxes, the list goes on. Or you can give it. Give it means legacy and charity. So there's literally 4 things when it comes to what you are using money for. And what this couple was using money for based on those 4 things, let me show you all that right now. So total family income before taxes, $286,000, not factoring in any bonuses or rental income, anything like that. So mortgages, so 35% of their income was going towards mortgage, which is spending. They were spending 35% on mortgage. They were spending about 8% on car financing, so spending 8% on car financing. They were spending about 38% on lifestyle, so you can see how much they're spending on lifestyle in terms of dollar amount, $60,800. They're saving 2%, so $3,200 per year is what they're saving. And then they're investing 15%, so $24,000 per year is what they're investing. And then they're donating or giving 2%, which is $3,200 per year. So you can see there's only 4 things one can do with money. They can spend it, they can save it, they can invest it, they can give it. This is what they're doing. Now, here's another way to look at it in a simple graph format. So 8% on autos, which means for every dollar they earn, 8% goes towards car payment. 35% on mortgage, which means for every dollar they earn, 35% is going towards mortgage on principal residence. 38% on living expenses, meaning for every dollar they earn, 38% is going towards living expenses. For every dollar they earn, 2% is savings. For every dollar they earn, 2% is giving. For every dollar they earn, 15% is investing. They're earning all the money, 100% of it, as you saw, but 100% of that money is leaving them, and that was a problem for them. Now, here's their asset classification. So principal residence, the fair market value is $900,000, owned obviously jointly between Andy and Jackie. RSPs, so Andy had about 200,000 in RSPs, Jackie $100,000. So combined as a family, that's 300,000 in RSP. The interest rate, which right now they may be earning 7%, but that has never been 7%. It's up and down, as you know. It's all investment, right? It can go up, it can go down. But let's give them a benefit of doubt that they're earning 7% on RSPs. Andy has 50,000 in tax-free savings account, and Jackie has 25,000 in tax-free savings account, which is total of $75,000. And then let's just assume that they're also earning 7%. So these are registered accounts in the US. There's similar registered accounts, they call by different names, right? Real estate portfolio. So the investment property that they have, the fair market value is $1 million on it. They have RESP, a registered education savings plan for children, which they have 25,000 as balance. They're earning 6% on it. Cash reserve, so they have money set aside for an emergency. It's about $20,000. So total assets combined. So when you add up all their assets, that's about $2.3 million. And when you look at it, that's pretty good. Now that's asset. So let's dive into liabilities. So the debt on principal residence, which is $600,000, that's how much they have as mortgage balance. And the interest rate on that debt is 3%. Car loan, they have a balance of $20,000 for Andy, $25,000 for Jackie. Between both of them, it's $45,000. And the interest that they're paying on the car loan is 3%. Lines of credit against the property, so they have some debt on it. They use this money to buy the investment property or make some renovations. So that's about $100,000, and the interest is 7%. The real estate investment property has a mortgage balance of $750,000, and the interest that they're paying is 3% on this property. They have an unsecured line of credit of $50,000, which is costing them 10%. They also have a trailer, which has a balance of $20,000, and the interest is 4% on it. So if you add up all the liabilities, that's $1.5 million. So let's do a summary of assets and liabilities. So let's see what happens here. So let's look at the net worth. So total assets are $2.3 million. Total liability is $1.5 million, which means net worth is $800,000, which is pretty good. Now, average interest that they're paying on investments, all the registered accounts that we talked about, the RSPs, the TFSA, the RESP. So the interest earned is 7% on all those portfolios. The interest paid on all the debt is about 5%. So when you look at this, it seems like they're doing pretty good, right? Net worth is $800,000. They're earning more interest on investments than what they're paying on their debt. So to them, it seemed like they were making some progress. But again, when they came to us, this is what they said. Seems like there's something wrong with the financial world, or there's something wrong with how we're going about doing the things that we want financially, because it seems like we weren't making any progress. We had no idea what was wrong until we read Nelson's book titled Becoming a Banker, Unlock the Infinite Banking Concept. So let's take a closer look at the financial picture. So again, graphs show beautifully in a very simplified fashion what truly is happening. Now, we talked about for every dollar, 6% is what they were paying on the car payment. Well, for every dollar, 2% is going towards interest on car payment. For every dollar, they were paying about 13% in payments. So out of the total payment that you're making on the housing loan, about 13% of that is principal and 22% is the interest. For every dollar that they they are earning about 4% of that, they're paying in interest on living expenses. They're not paying any interest on savings or giving, but they're earning about 7% interest in the investing. So this is where it beautifully shows what is wrong financially for them. So if you add up all the interest payments, all the volume of interest that they're paying on all the debt, so 2% on car, 22% housing, that's about 44%. And then 4% on living. So 22 plus 2, that's 24%, plus 4, that's 28%. So the interest volume paid on every dollar that they earn is 28%, and the interest volume earned on every dollar that they're investing is 7%. And that was the problem. And then again, doesn't matter whether they're earning interest, paying interest, who has all the money and who's getting all the money. All this money resides in someone else's bank. All this money is going to someone else's bank. It's not with them. So total assets, $420,000, total liability, $1.5 million. These are the interest, this $420,000 is all the RSPs combined, TFSA combined, and they're earning 7% interest on it. Total liability is about $1.5 million, including all the debt on principal residence and investment property and the cars and the trailer. And the interest paid is 5%. So you can see they're earning 7%, which is $29,400 in volume. And then they're paying $75,000 in interest, which is the volume of interest paid at 5%. So people look at the rate and they say, okay, I'm earning 7%, I'm paying 5%, I'm making progress. Well, if you do the math on the volume of interest earned and the volume of interest paid, then you know it's not actually financial progress. They're in a negative of 45,600. Because if they're earning 29,400 and paying $75,000, that's a negative balance. They have to earn at least 18% on all the investments to just break even with all the interest that they have to pay on liabilities. And if you just think about how easy it may be to earn 18%, or how difficult it could be to earn 18%, which one's more logical? Easier to earn 18% before taxes or difficult to earn 18% before taxes? For every step they were moving forward, which is the interest earned on all the investments, they were going back 2.5 steps, which is the interest paid on everything that they owed to the bank. So if you imagine this, so this is where you are today financially, and the destination is where you want to go financially, and then you get in an airplane. So airplane is taking you from where you are today, and it's getting you to destination, which is where you want to be financially. The airplane speed is 100 miles per hour. So when you go up in the air, the 100 miles per hour, that's basically the one step forward on the investments that they're making. When you go up in the air, you're faced with a headwind of 250 miles per hour, which is the 2.5 steps that they're going backwards and all the interest that they're paying to the bank. So if they're operating in this environment and the objective is to change how they're doing things financially going forward, well, you can put it in the chat right now. If they continue to operate in this environment, are they actually going to get to the destination? If you're moving forward at 100 miles, you have a headwind of 250 miles per hour, you're probably not going to get to your destination. You're going to go backwards financially. And that's exactly what was happening to them. So here's a frequently asked question. The process of becoming a banker is only for people who have debt. If I'm paying cash for things, I don't get into debt. I don't need to become my own banker because I don't finance anything. I don't pay interest. So the environment of headwind doesn't apply to me because I'm not paying any interest to anybody. I save up cash and I use cash for the things that I want to buy. I don't get into debt. Well, here's the truth. Here are some facts. You finance everything that you buy. You either pay interest to someone else, aka borrowed money from a lender, financial institution, or a banker. So when you borrow money from them, you pay interest. Or you give up the interest that you could have earned when you pay cash for things. Because when you pay cash for things, that money is gone forever. You're not going to be able to use that money again. You're certainly not earning any interest on that money ever again. You cannot invest that money ever again. It's gone permanently, not just over your lifetime, but for your generations to come. And here's the pain of paying cash. If you haven't done this math, Well, go ahead and do that today because you know your financial situation better than anybody else. And I'm going to walk you through the pain of paying cash. So let's presume there's someone so this person is age 30 and they saved $1 today inside a GIC or a CD. So if you're in Canada, GIC, if you're in the US, CD. And let's presume this GIC or CD is giving them 5% per year. So if they put that $1 into CD and GIC and it's earning 5%, by the time they reach age 65, that $1 will become $6. So you put $1 inside an investment at 5% and you don't touch it. By the time age 65 comes, that $1 becomes $6. What that also means is if you take that $1 and you take it out from this compounding asset, and then you buy the things that you want to buy or use that money for anything that you want to use, you will also have $6 less at age 65 because that money could have been working for you. So paying or paying cash. So if you're age 30 and you spend $1 in cash, you basically have $6 less to spend at age 65. You are penalizing your future self to have less money when you pay cash. That's the pain of paying cash. If you're 40 today and you spend $1 in cash, doesn't matter what it is. By the time you reach age 65, you'll have $3.50 less to use. If you're 50 today and you spend $1 as cash, by the time you reach age 65, you will have $2.15 less to use. If you're 60 today and you spend $1 as cash on anything, by the time you're 65, you'll have $1.30 less. Now, I know and you know you're not spending $1 cash or debit, you're spending a lot more than that. It's thousands of dollars. So if you're 30, do the math on how much money are you spending today, which is just leaving your family in cash transaction. Multiply that by 60, that's the pain of paying cash. If you're 60 and you're buying things using cash or debit, multiply that by 1.3 because that's how much is the pain of paying cash by the time you're 65. And that's a fact. So every decision that you make with the use of money is a financing decision. You're either paying interest to someone else, or you losing interest that you could have earned. So becoming a banker is not about a process which only works if you have debt. Becoming a banker is a process of recapturing the interest paid or recapturing the interest that you're going to lose so that you are in a position of total control and total accumulation going forward. So if you're paying cash and same scenario, and this is where you are, and this is where you need to go, and you're flying at 100 miles per hour because you're paying cash, you save up cash, you don't get into debt. So anything that you want to build, anything you want to buy, is all based on how quickly you can save money. It's all based on how much you earn and how much of that money you can save. It will get to your destination, no doubt about it, but only at 100 miles per hour. What if you get sick? That 100 miles per hour now stops because you don't have money coming in. So this is losing interest. So here's a nice summary. So when you use your cash, you lose interest. When you lose interest, you're penalizing your future self because you'll have less to use in the future. And when you pay cash for things, who got all the money? Someone else did, not you. And when you borrow money from the banks, you're paying interest. And when you're paying interest, it's a cost, right? It's a headwind. And then when you're paying interest to someone else is getting all this money. You're not keeping any of your money in option 1 or option 2. And if you're not keeping money, which means you're keeping less of it going forward, which means the 4 things that you can do with money, which is save it, invest it, spend it, or give it, you'll have less to do in those 4 categories. But when it comes to the infinite banking concept, you're going to recapture the interest. And when you recapture the interest, you're going to have clarity on, once I go through some case studies, that you actually have more to use in those 4 categories that you can use money for. And you also get to keep the money in the family. So recapture interest advantage. You get to keep all of your money, which means you get to save more. You get to use more of your money, which means you can spend more. You get to buy more investments, which means you can invest more. You get to make more donations, which means you can give more. And you get to transfer more as legacy, which is keeping more of your money in the family. So let's go back to Andy and Jackie, and let's look at their interest recapture solution. So here's what was happening. For every for every one step that they were making as progress, so one step forward, which is the interest that they were earning, they were going back two and a half steps, which is the interest that they were paying. So this is what was happening. Now, if they recaptured the interest, meaning they get to still do the exact same thing. They're not working any harder. They're still saving exactly what it is. They're still earning that interest. So they're still taking that one step forward, which is 100 miles per hour, which is the plane speed towards the destination. Because now the interest is being recaptured, that interest recapture has a financial tailwind on top of what they were doing. So that 250 miles per hour is not negatively working for them. It's actually positive. So now the total plane speed is 350 miles per hour. So now they're going to get to the destination much quicker. When a flight has a tailwind, and let me ask everybody this question. When a flight has a tailwind, it and its passengers don't just get to the destination quicker, but they also get there with less fuel usage, which means the airline spend less money to get to destination, and spending less money also means more profit. So when you have when you're recapturing your interest, when you're working in an interest recapture environment, you're not just going to get to your destination, which is your financial destination, quicker. You're going to get there with less stress, less cost, and more profit. And quick question for you, do you see any disadvantage in getting to your financial destination quicker with less cost and more profit? Type in N for no. And if you type in Y for yes, then I think you can use your time better doing something else, because this webinar is not going to add any value, because this is what our clients want to get accomplished. Get to their destination quicker, less cost, and more profit. Right. So this is the present environment. They're in a negative 45,600. The interest earned is 29,400. The interest paid is 75,000. So that's a negative 45,600. When they're working towards an interest recapture environment, the interest is working for them, not against them. So the total speed is much higher. And that's what we're going to talk about, what happens when you become your own banker, because that allows you to recapture interest, not pay interest or lose interest. So this is what is happening in their financial world, and it may be happening in your financial world also. So you're making a mortgage payment, you have a car payment, you have a credit card line of credit payment, payment for your appliances, maybe payment for house remodeling, payment for furniture, payment for vacations, payment for clothes, property tax, food, boat payments, healthcare plans, investments, medication, religious and charitable causes, chiro, physio. These are just payments, right? This is literally the four things that you're doing with money. You save it, you spend it, you invest it, or you give it. And then, as you can see, even for them, all those arrows are pointing outwards, because they were doing all the work to earn all that money that they were earning, about $280,000 gross income per year. But at the end of the year, all those payments were gone. They were leaving them permanently. And they wanted to change that. So they wanted to redirect the flow of all those payments back into their system. And then the math on all those payments, the amount of money that they're spending every year for doing all this is $160,000 a year. So we're going to show you how building the system, they recaptured all that $160,000 every year. Now, one question that we get asked is, do I need a lot of money to get into the banking business? Well, the answer is, you don't need a lot of money to get into the banking business, but you do need to get into the business so that you can keep a lot of your money in your family going forward. And it doesn't matter how big or small the system is, the principles of using the system are going to be exactly the same. And here's the best part, you can always grow your system. And there's no restriction to how big it can grow. And think about this logically. Isn't it true today all your income is flowing to the books of someone else's bank and you're okay with it? And when you get into your banking business, you have to work towards having all the money flow through your system, because you become the banker now. And you can do this and you can get there. Here's a really good client series videos. The gentleman who he's a client, his name is David, and I just want to share his testimonial. I'm just going to stop the screen sharing for a bit and bring up his testimonial up on my screen here. So this is what David says. 7 years ago, a friend told me about the infinite banking concept. And to be honest, I felt it was too good to be true. I'm a very skeptical person when it comes to money, as my father worked for 30 years for the CRA. He gave me the book, Becoming Your Banker by R. Nelson Nash, and after reading it, I was instantly doing more research on my own to poke holes in this novel, but excited about the concept. Once I couldn't find any holes, I made an appointment to meet with the IBC practitioner. 2 years after opening our first policy, we took our first policy loan and paid off the bank loan on my wife's Subaru, redirecting the payments from the commercial bank to our family bank. 3 years later, total 5 years into building the banking system, we took out another policy loan and skipped the bank entirely this time, using the money to buy me a brand new SUV outright. In 5 years, in year 5, we also had another child and took out a policy on him as well as a second policy on myself. With 5 policies in force after 7 years, our mortgage was coming up for renewal. Instead of renewing with our bank, we took out a policy loan from all our 5 policies and paid off the bank completely. After these 7 years, I know we have the freedom and flexibility to do whatever we want, whenever we want, on our terms. This is a feeling I can't explain, but to say it is amazing. So again, you don't have to be rich to get into the banking business. You have to start so that you can keep a lot of your money in the family going forward. And you will expand your system as time goes on. That will happen for sure. All right, I'm just going to reshare the screen and bring it back about. One second. And then, Roman, may I ask you to post David's interview in the chat option, please? And again, I'm just repeating myself. Thank you, Roman. Don't watch it right now. Just save it for later. So anytime during this webinar, if you're in Canada, text the word schedule to 780-809-4599. And if you're in the US, text the word schedule to 813-793-7921 and schedule a time that works best for you so that we can start to have conversations on how you can experience what Sandy, Rikas, and David is experiencing after implementing the process of becoming a banker. And we'll also give you a gift. So if when you schedule the call and at that call, because you'll be connected with one of the amazing IBC practitioners that we have on team. We have 19 practitioners now, which is beautiful. So when you at the call, the practitioner will give you more wealth of knowledge. This whole package is worth $97. We call it the Wealth Accelerator package. And a little bit about this package is it has very specific case studies or examples of how someone paid off their mortgage. This case study, for example, is just focused on mortgage. If someone wanted to focus on radically enhancing investments, and then there's a case study on how someone can radically enhance investments. If you want to focus on recapturing debt, then there's case studies on how you can just tailor your system on just recapturing debt. So when you schedule that call, at that call, your practitioner will share this with you. This is a gift from us. Now, what's required to become a successful banker using the infinite banking concept? So let's talk about that. What's the requirement? So the requirement to become a successful banker, the first requirement is to be coachable. And here's the thing, all our 19 coaches are authorized IBC practitioners from the Nelson Nash Institution. So when you work with them, they're going to coach you, and there's no expiry on coaching. But along coaching, there's also accountability to the process. So your coach is going to hold you accountable to all the things that we have discussed. And when it comes to executing this process in your life, we're going to hold you accountable to execute this process. And that's when the progress literally starts, is when there's accountability. The other requirement is don't hesitate to ask for support. So the way you can ask for support is, so we have an amazing Facebook group, and this group is all client and prospect clients. And you can actually join this group and ask questions, and you'll see most responses to your questions or queries are actually going to come from the group itself, not from us. We have a client portal. So when you become a client, you'll have your own personal private portal. And when you log into this portal, you can watch other pre-recorded exclusive content, which is not available to public, but only for existing clients. And this content is available and sits in the portal 24/7, 365. And in addition to that, from extra support standpoint, we also do quarterly client coaching sessions. So this is a print screen from the portal that I just showed you. And you can see the most recent client coaching session was August 17, 2024. So we do this quarterly, and you'll be invited to quarterly client coaching sessions going forward. And in addition to that, there's also one-on-one strategy planning with your assigned coach. And all our coaches are amazing, and they can all help support you in your journey going forward. The other requirement to become a successful banker is to always be curious, to learn more. There's no such thing as having arrived in knowledge. Meaning if someone says, I know everything that there is to know in this world, you cannot teach me anything new. Well, unfortunately for that person, it's all downhill, and that person was not going to fit good in our ecosystem either. So if you're always curious to learn more, that is one attribute that's required to become a successful banker. And here's how you can learn more. We have a fantastic YouTube channel tailored towards Canadians and Americans. It's called Banker's Vault. And right now on this channel, we have more than 900 videos. So case studies, client series, client interviews. So there's a combination of many things. And then if you are looking for a very specific way that you think that you want to become your banker, you can just, there's a search option on this YouTube channel. You can click search and you can type in the keyword, and I'm pretty sure a video is going to pop up which ties to what you're looking for, because we have over 900 videos. The other thing is our YouTube, our podcast, which the podcast has, obviously it's on Apple and all the platforms, but it's also on the YouTube. There's a podcast channel, YouTube podcast channel. The name of the podcast is Wealth on Main Street. You'll find client series interviews. This is where Jason and Richard, they just add extra value to existing clients, prospect clients on the process of becoming a banker, the infinite banking concept. The main idea is to help you rethink your thinking about what truly is happening in the world financially. Because when you know what's happening, you know exactly what to do. And there's education books. So you can go to a website, get these highly recommended books, starting with Nelson's book titled Become Your Banker. Just an FYI, when you schedule the call, part of the Wealth Accelerator package, we're going to include a digital copy of this book, The And Asset. The And Asset concept works in Canada and the US. All the process that we're talking about has no boundaries, right? If you're a business owner, you may want to pick up this book, The Case for IBC. And we also have quarterly book series from our podcast, which is The Wealth on Main Street. The Don't Spread the Wealth is the newest addition to this quarterly series, but there's 3 others to pick from. So from education standpoint, you will have plenty to learn and continuously learn. So let's get Andy and Jackie into the banking business. So we understand what the problem is. The problem is they're taking 1 step forward and going back 2.5 steps. And they want to fix that. So they want to build a system to recapture 100% of the outflow, which on an annual basis is $160,000 a year. This is what they're using. So they use that $160,000 to basically pay for all the things that they are buying today, mortgages, cars, things that I just have shown you. And here's the thing, objective is not going to work if there's no timeline attached to the objective, right? There's no such thing as unrealistic goal, but there could be an unrealistic timeline associated to accomplish the objective. So for them, they wanted to get it done in 6 years. That is their goal. I want to recapture $160,000 in less than 6 years. So before we dive into showing how they put it all together, I want to spend some time just talk about the perfect tool, which is required to build the perfect system. And this perfect tool has the true attributes that you need, which is the recapture interest. It allows you to recapture interest. And because it recaptures interest, it creates a financial tailwind. And this tool is called participating dividend-paying whole life insurance. That's the tool. The tool and the process are two entirely different things. So I'm going to spend some time talking about the tool, but then I'm going to spend a lot of time talking about the process. Your bank checking account is the tool that you use to flow money. Participating dividend-paying whole life insurance is a tool that you need to store money and then you flow money out of it. The objective is not to change your goals or cash flow. The objective is to change the process to get to the objective, so that that process is a process of recapturing interest, and it fixes the problem of paying interest and losing interest. So actually, this is a really good fun exercise. Now, let's talk about the perfect investment. So if you could invent a type of an asset where you can put money in from scratch today, let's just say you're the inventor, you building this asset where you want to put some money in, and that asset had no drawbacks. What would that asset look like? So what would that perfect investment look like? So I'm going to get you started with some attributes, but if you don't mind sharing in the chat, so remember participation, right? So the more you participate, you'll be entitled to receive a copy of a book. So I'm going to start up with some attributes. So one of the attributes of perfect investments is high rate of return. The other could be consistent rate of return. So please share in the chat, if you were building an asset class from scratch, what attributes would you assign to this asset class? And then if I may ask you to just share some of those feedback from the attendees in the chat on the perfect attributes.
Sure. We have compound interest. We got a 20% rate of return. Borrowing without high interest, tax deferred profits, passive income. What else we got here? Passive, increased cash flow, or no taxes, no fees, higher return, lower risk, tax-free. Lots of good comments coming in.
Perfect. Awesome.
Liquidity. Yeah.
Yeah. Well, thank you all for sharing. So here's some of the other perfect investment attributes for the perfect investment that you can align to it. So safe, liquid, guaranteed, tax benefits or almost tax-free, no market volatility, yields income besides capital gains, credit protected, inflation protected, control, transferable, easy to manage, no hidden fees or penalties, reputable, private. So for your own various asset class, so wherever you are presently storing money, think about, simply identify which of the features from the list above that they do well on and which of those features they fail on. So wherever you're storing money, compare the attributes of that warehouse with this warehouse and think about where they're doing well and where they're failing, right? Because everything that we do financially is how someone else is doing, right? So when we compare things, that's when we know what we have and what we don't have, right? So surprise, the list of all the attributes that I just showed you accurately describes the participating dividend-paying whole life insurance. Those are the attributes. So there's a few components of this policy, participating dividend-paying whole life insurance. So one component is the premium. So like any insurance products, if you have car insurance, you have home insurance, you have tenant insurance, you have to pay to get the benefit from the insurance company, and that payment is the premium. So for participating dividend-paying whole life insurance, no different than any insurance products, there's a premium, a payment, which you can call it a deposit into your banking system. So no different than how you make deposits into someone else's bank. Premium payment is how you get to move the money into the policy. So that's your deposit. In exchange for your premium, because it is life insurance, they're going to produce a very high level of death benefit. And the death benefit is always paid tax-free in Canada and in the United States. Now, there's also something called cash value. Cash value is the capital that belongs to you. You can access that capital, and the cash value grows tax-free on daily basis based on contractual guarantee set by the insurance company. And the contractual guarantee is that by age 100, cash value must match the death benefit. So whatever the death benefit it starts at, the cash value has to increase to match this death benefit by age 100, but the death benefit also compounds every year, which would grow more and more cash value. So the contractual guarantee is cash value must grow every day to match the death benefit by age 100, which means as time goes on, there's going to be ups and downs in the economy. There's going to be ups and downs in interest rates. Whatever happens in so-called the financial entertainment world, your cash value are protected against it, meaning your cash value will not stop growing. And the word participating means anybody who has a policy contract like this with the insurance company, they just don't own the policy contract, they actually co-own the insurance company. And when insurance companies become profitable, they pay or share their profit to participating dividend-paying whole life insurance policy owners via dividends. So dividend is an icing on the cake, right? So there's the cake, and then there's the icing on the cake. So dividend is the icing on the cake, and it's the divisible profit. And if structured properly, dividends are also going to be tax-free. So as time goes on and cash values, the capital continues to compound and accumulate and grow. So your cash values, you can access capital from policies via two methods. One method is you can access your cash value. So let's say you have 50,000 of cash value and you need money, you need access to that 50,000, you can access your own cash value. The other thing you can access is, the other way to access money is by not touching your money. Let your money sit in the policy and continuously grow, because cash value has to grow to match the death benefit by age 100. The other way you can access capital is via policy loans. And policy loan is not your money. Policy loan is insurance company's money that they're willing to lend against your cash values. And what you can access as a loan is 90% of cash value. And here's another fun fact of the policy loan. There's no qualification required for policy loan. It's already pre-approved. What you can access is 90% of your cash value. And when you access a policy loan, you just have to let the insurance company know, A, how much you need, and whether you want that money via check or you want that money electronically deposited, and that's all that they ask for. Because when you access policy loan, they're going to use your cash value as collateral, and they're going to put a lien on your death benefit. So if the loan is outstanding and that occurs, it'll be deducted from your death benefit when you're gone. So insurance companies don't even have a schedule for a repayment of the loan. That policy loan is unstructured. The only person who determines how to pay back the loan is the policy owner. So you can access money via two methods. Now, here's the rhetorical question. Do you believe in earning uninterrupted compound interest? I'm not asking, do you believe in compound interest? I'm asking, do you believe in earning uninterrupted compound interest? If you believe in it, just put Y in the chat box. Dan, what are we getting?
We're getting a lot of yeses, lots of
A lot
Ys.
of yeses. So if you believe in earning uninterrupted compound interest, well, here's something to understand. If you access your own money, you're going to interrupt the compounding. If you access money via policy loans, you're not going to interrupt the compounding. So how would you access money? Your own capital, stop the compounding, go backwards, or access money via policy loans and never interrupt the compounding of your own capital and have the privilege to replenish the capital on your terms by paying it back. So this picture here does a beautiful job explaining exactly what's going to happen when you access money as a policy loan. So think about this green dot as your cash value. So the cash values, let me actually get a pointer, like a laser pointer. Let me see if we can do that. Yeah, there you go. Right. So this green dot is your cash value, which has to grow every day to match the death benefit by age 100. So it continues to grow no matter what. Whatever happens outside of this policy in the financial world, the cash value continues to grow. Now, let's say we reach a certain point in the policy and you need access to money. And what you're going to do is, because you all agreed, you want to work in an environment where you don't interrupt your own compounding. So you can access a policy loan. So when you access this policy loan, insurance company gives you the money and you get to repay the money back, the loan repayment on your terms, whether it's a year, whether it's a day, a week, a month, semi-annual, annual, 2 years, 3 years, 5 years, 40 years, 50 years, you decide it. There's no restriction on it. It's just what works for you because you are going to be the banker. And then you repay the loan back. Now the question is, well, how much is the interest? Well, we're going to look into the case study on how does it all work with the interest recapture, but conceptually, just want to show you this here. You borrowed money here, you paid the money back over whatever terms. Then when you pay the money back, you're paying the principal and interest back. And when you pay it back, you get to reuse more than what you repaid because your cash values continue to grow no matter what. And what you can re-access is all the principal and the interest again because your cash value kept increasing all this time. And then the same phenomena happens. Next time you're ready to take a policy loan, you take a loan, your cash value continues to grow uninterrupted. You pay back the loan on your terms. You get to recapture all the money, principal and interest back, and then you get to re-access all of that money again, more than principal and interest that you repaid because your cash values kept increasing all the time. And this process continues no matter what. Right. I just need to do this here. Right. Now, Dan is going to walk us through a grocery store example, a grocery store business. Now, you must be wondering, well, we are here to talk about the process of becoming a banker. Well, what's the grocery store business got to do anything with the process of becoming a banker? And this is coming straight from Nelson's book on page 15. The reason why we want to walk through this example is because when you're getting into the banking business, it's a business. And the purpose behind any business is to be profitable. And Nelson wanted to just relate to you the whole principles of banking business with the business that you may already be familiar with, because you may not be familiar with how the banking business works. So he says, let's talk about a business called the grocery store, because when you own a grocery store, you have to consume your own groceries. You need the groceries, but you also can distribute the groceries to someone else who needs to consume these groceries. No different than groceries. If you get into the banking business, you need money for your own purposes, but you can also distribute that money and control the banking function for your family as it pertains to their need for financing. And the inventory to grocery store business is the grocery, and the inventory to the banking business is the money. So Dan, please walk us through the grocery store business.
All right, I'm going to do that. So thanks for all that great information you shared. Lots to take away. Can you see my screen now, Servlo?
I sure can.
All right. So as Servlo mentioned, I'm going to talk about getting into the grocery store business. And, you know, if you haven't got a copy of Nelson's book called, you know, Becoming Your Own Banker, I'm going to encourage you to get that. And page 15 and 16 of that book, Nelson talks about the grocery store and the business. And it really, the part that I always took away from that, and this is a quote right from Nelson, and you'll see it throughout his books, throughout his book. Whereas if he says you don't understand something, go back and reread the grocery store example. Because once you understand the grocery store example, the rest of becoming your own banker is ridiculously simple. So we're going to take a bit of a look into getting into the grocery store business. Now, Servo already spoke about this. So one thing that's unique about grocery store is you're a consumer. And if you own that store, you're also the seller of the same product. So when you relate that to this process we teach, you become a consumer, and you also have that warehouse where you can access money. Now, the other thing to point out is your market is unlimited. Everyone uses groceries. And when you relate that to money, everybody has the need for money. We're going to have the need for money for the rest of our life. So our market is unlimited. When you're in groceries, everybody needs to eat. And someone has to perform the function of distribution. Just like we talked about, that pool of money out there, someone controls it. Someone has to perform the function of distribution when it comes to a grocery store. That's right. Without it, we'd have to be out there foraging for our own food. But as it is, we have grocery stores we go to, and someone is looking after the distribution of those groceries. So what does it take to get into the grocery store business? Well, you and I both know that if you're going to get into something like that, it's going to take some time, prep time. Any business, if you started a business, you realize it's not something you do on a whim and it just starts. You have to take time to educate yourself, and the people that do it successfully take a lot of time to understand the business they're going to go into. Find the people that have already done it. See what you can learn from it. So it takes time to study the business. Then you're going to have to purchase a superior location. What is it we always say about real estate? Location, location, location. Well, it'd be the same if you had a grocery store business. You want to be in a good location, so people will be more likely to come into your store. And you got to build an attractive building. Let's face it, people like attractive buildings. They like to go into something that looks good. So that's going to take some effort to build an attractive building, and it's going to cost you something. And then, as Servlo said, you got to put the products in there. You got to stock those shelves with high quality merchandise, because when people come in there, their expectations are high. And the more you meet them, the better off you're going to be. Now, here's a question, and I want you to jump into the chat box that I got for you. So up until this point, and you also had to hire the staff to do this. Don't forget that. You have to hire people to help you run a business. And a grocery store would be no different. There's a lot of work keeping those shelves stocked and moving inventory out, running the tills, those kind of things. But at this point, here's the question. Up until this point, you've built the business, you studied it, you got it all ready to go. I want you to ask you one question. How much money has your grocery store earned up until this point? So put that in the chat box.
Zero, nada.
Nothing. So you can see, when you start a business, there's always a lot of money that you put up in front, a lot of work that goes into it. Anything worthwhile doing takes effort. So that's one thing I wanted you to understand as we went through this example. Now let's get into how the grocery store business works in a little more detail. Now, because of all those costs that we talked about, there's going to be interest on the loan, because most people, when they start a business like this, are only going to do it by taking on debt. There's going to be interest, all those costs related to staff and all those things we went through. You're going to have to sell, your inventory 15 times just to break even. That's right. You got to turn over stuff 15 times just to break even. And one thing you know about the grocery store business is that the margins are tight. So once you turn that inventory 17 times, you will be profitable. So that's where you want to get to. You want to be profitable, because without profit, every business will fail. You have to have return of your investment and profits to be effective in business. Now, if you are able to turn that inventory 20 times, you get to a sweet spot. Now you're going to be able to, you're putting much more capital back in your business. You're going to get to a point where you can retire much earlier, even though, I don't like the word retirement, because a lot of people say, Dan, you should be retired, but I'm not. And I don't plan on retiring, because I'm not going to take myself out of service. But if you do get that inventory turn at 20 times, you're going to be making much more profits, and your business is going to get to a sweet spot where it just gets stronger and stronger. So inventory turnover in a grocery store is huge. Now we're going to look at this little picture, animated picture of a grocery store, and we're going to go through a few things. So this is just, a sample of a can of peas in the warehouse. And the first thing we're going to look at is, what does it look like when somebody takes that can of peas out of the grocery store? So there it goes. It goes out the front door. And one thing I want to tell you is the difference between the front door and the back door is a very good living. So this always begs a question. I'm going to go a little further before I ask that question. I'm going to go this far. So as soon as that can of peas goes out the front of the store, you got to replenish that. You got to have that inventory. You got to restock, because a store that doesn't, that has empty shelves, pretty soon people don't come back. So you sell one can of peas, you got to bring in a can of peas to replace it. So that's kind of important. The other thing I wanted to see here is that cost of that can of peas is 57 cents and you sold it for 60. So that just gives you an idea of how tight the margins are on something like a can of peas. Now, here's a question I got for you. Say you and I own this grocery store. Well, where are we going to shop? Well, I hope your answer would be, well, we're going to shop in our own store. Like, why would we shop anywhere else? So and this is a good question and thought for you to think about, because I've actually asked people who own grocery stores, when you take the food out of your grocery store, how do you take it out? The front door or the back door? And the one person in particular that I talked to that owns a nice little grocery store said, well, we always take it out of the back door. Well, here's one thing I want you to understand. If you or I, as the owner of this grocery store, took that can of peas out the back door, we'd now have to sell 20 cans out the front door just to break even. Now, what I really want you to understand is you want your business to be profitable. How do you make your business profitable? Well, it's by selling merchandise. So you want to sell as much as you can sell. And even better, if it's you and me that own this store, and we're going to take produce and use it for ourselves, I'm going to tell you to do this. I'm going to tell you, for all the captive, customers that you have in your store, like me and my family, if I own this store, we're all captive customers. We're going to actually pay 62 cents and not 60 cents like those other customers that are taking it out. Now, here's what I want you to think about. Why would I suggest doing something like that? Any thoughts? I'd love to have your thoughts on why would I suggest that you actually pay 2 cents more than someone else because you own the business and you're a captive customer. Let's see if we got any thoughts in the chat box on that one, Servo.
We are, Dan. We're getting help to replenish. So I can use the extra 2 cents, investing in yourself, more profit, higher compounding, more profit, interest on line of credit. That was interesting. You can buy more peas going in your pocket.
Exactly.
And one person says family won't want to pay more.
Yeah, ain't that the case? Yeah, likely they're going, why would I pay more? But here's what it's all about, is the more captive customers you could get that are paying that extra 2 cents means more profits for your business. Who's ever heard of more capital being a problem for a business? Well, it doesn't happen. You get to take that extra 2 cents, and really that extra 2 cents is like a 40% increase in profits, and put it back into your business. You can buy, more inventory so that other people who come in, have a better selection. It just builds your business quicker and stronger, and you get to that point where, your profitability gets much better in a shorter period of time. So if you compared someone that had this kind of a process working compared to somebody who didn't, their books would look much better. And if you ever wanted to sell your grocery store, well, what's going to sell it? It's like, how profitable is your business? So it just makes sense to put more capital in your business. And when I really want you to understand, when we talk about this process called becoming your own banker, and when you'll see this later in our presentation, when you take policy loans, and Serval did a good job of going through, that's the way that we're going to coach you. We're going to coach you to use policy loans. Now, the life company's going to charge you an interest rate. And what I coach my clients, and we're going to coach you to do, is pay that back at a higher interest rate than what the life company's actually asking for. And when you think about that, well, what does that do? Well, you're putting more premiums into your policy. You're building more strength, more capital in your system. It's just going to get stronger, quicker. And you're going to have a better system than you would if you just pay it back, which you could do at the interest rate that the life company's asking for. So we're going to encourage you, pay attention to the rest of this presentation. Think about, I really want you to get a clear picture of why would I pay extra interest to the life company? Because it adds value. So we're going to go through and talk about one other thing. Now, this is a quote right from Nelson. God bless him. And I already mentioned part of it earlier. If you understand the grocery store example, the rest of becoming your own banker becomes ridiculously simple. And don't steal the peas. What does that mean? Well, that means pay your policy loans back. Don't steal from your own system. Have a plan to pay it back. And that works. And, it's been proven by our clients, by those of us that use us. That is a way to really keep your system strong. Don't steal the peas. So I hope you found this interesting. On that 2 pages that we reviewed out of the book called Becoming Your Own Banker. And again, I'm going to encourage you. If there's something that you don't quite get or you want to really understand, go back and read the grocery store example. Read it often. I try to go through it every once in a while just to remind myself about what Nelson was helping us understand in those 2 great pages in his book. All right, back to you, Servalo. Continue to share on how Andy and Jackie put this process into practice.
Oh, thank you, Dan. What an amazing way for you to just walk everybody through that grocery store. I got super excited and I shared in the chat box, I said, the difference between walking through the front door, paying cash, and which means extra interest as compared to the back door, it's just better way of living going forward.
Exactly.
It can't be more simpler than that, right? Awesome. Thank you, Dan. All right, I'm going to share my screen, Dan. If you can just let me know you can see it okay.
We got it.
Perfect. So Dan walked us through a grocery store business. Now, this process is not restricted to individuals. It works beautifully also in your corporation, in your business. Now, one thing that we do is when we meet with business owners, we tend to get into like a mastermind discussion on businesses and operations because, we want to bounce some ideas of the business operations from each other. And then it all boils down to when business owner talks about, I'm not achieving this result, I'm not achieving this outcome. Well, the reason why that's happening is because you don't have a good process, because only good processes produces great outcomes. And banking is a process. A good banking process will produce good outcomes, right? So banking is a process, not a product. And here's 6 banking principles. And if you implement this, which is what we're going to coach you on, you will never lose again. So first is, don't be afraid to capitalize. So, Dan walked us through the grocery store business and he talked about the importance of capitalizing the business, putting money in, buying real estate, computers, IT, team members, inventory. You have to capitalize. The more you capitalize the business, the more business is going to produce for you going forward. Now, where is it important when it comes to the process of becoming a banker? Well, premium is your capitalization into your banking business. And premium, I'm going to do this first. And premium is not a cost. Premium is a solution to the problem. And bigger the problem, bigger the solution, meaning bigger the premium. Think long range. And when Nelson says think long range, he's not talking about the next 10, 15, 20, 30 years or just our lifespan. He's actually talking about 3 generations past yours. This process of becoming a banker is going to serve you well in your lifespan, but it needs to be built across 3 generations. See, 3 generations past yours is what thinking long range is, and teaching about legacy to children and custodianship are just 2 different train of thoughts with 2 completely different outcomes. Most people talk about legacy. We talk about custodianship because the process of banking will continue no matter what for generations to come. And someone has to control this process for you. Who is better to control this process for you and your family other than you and your family? Third, don't do business with banks when it comes to financing needs. right? Build your own banking system to do it. Because if you're doing business with banks, you're part of the problem. And that's all I'll say about that. Fourth, Dan mentioned beautifully, don't steal the peas. Be an honest banker, pay your loans back. See, you may struggle with the importance of paying the loans back. And if you understand the grocery store business beautifully, that struggle will go away. But I want to make a really good, important teaching point here. So think about this. So you have a cell phone. I'm sure everybody uses a cell phone, right? So when you lose juice in your cell phone, meaning when it becomes discharged, there's no enough battery left. You plug that cell phone in the wall and you charge it. And the reason why you charge it is because you want to reuse it again, correct? If you don't charge it, you can't use it again. You may be driving cars today. And when your car runs out of fuel or charge, if it's electric car, when it's low on fuel, low on charge, you refuel it and you charge it. And the reason why you refuel your car and you recharge your electric car is because you want to use the car again. Think about food. You know, when you open your fridge or wherever you stock your groceries that your family needs, when you go low on that stock, you go and then you restock it. And the reason why you restock it is because you want to continue eating, otherwise you'll die. So you will recharge your phone, you'll refuel your cars, you'll restock your pantry with food, but somehow paying back and recharging and refueling your own tank of money is a foreign concept, which boggles my mind. You're okay refueling, recharging everything, which you can only do with money, but the one thing that you need more of is the money. It becomes a foreign concept to recharge it. So be an honest banker and pay your loans back. And always rethink your thinking. And the reason why Nelson added that principle is because Nelson wanted you to remember not what you bought, but why you bought it. So Nelson didn't want you to remember what you bought is the participating dividend-paying whole life insurance. But the reason why you got into participating dividend-paying whole life insurance is because to control the banking function, to recapture the interest, to never lose again. Remember why you're buying it, not what you bought. And the last important principle is make room for future windfalls. And I have a note just to remind myself to actually expand on a strategy that we have implemented in our own family. So we practice what we teach, right? So in our family, we all start with one policy. So I start with one policy and it's grown to about 16 policies now. Policies on myself, policy on my wife, policy on our daughter. So I'm going to use an example of the policy on a daughter. The policy that we have on a daughter is not a policy for her. It's part of the family banking system. When she needs money, she can come to a family banking system and she can access money from any of these 16 policies. It doesn't have to be just her policy. Now, as we mature, so as we get older, so me and my wife, as we get older, we're going to rely on some passive income going forward. And the passive income, the source of passive income is going to be these policies that we have, including the policies that I have on my daughter. So we're going to use these policies for passive income time tax-free. And when we leave, because it's not if, it's when we graduate, when we pass away, there's 100% probability of us dying, not 99.9%. So the other problem that this fixes for us is a permanent death benefit, which is going to come walking in the day we walk out. And that death benefit is going to be for the family so that they can take the time to grieve and continue living, right? So at some point in future, we've taken policy loans, we've taken loans on the policy, and I've passed away, my wife's passed away. Our policies will pay that benefit, while my daughter at that time will take over her policies, but her policy is going to have a lot of loans outstanding because we use those policies for us. Well, what do you think she's going to do with the death benefit that she's going to receive from me and her mom? Those death benefits, which are tax-free, are going to backfill the loans on her policy, and she gets to use that policy as if there was no loan outstanding on it. So make room for future windfalls because there are going to be future windfalls. Nobody talks about it. Everybody talks about the rate of return. Well, how about let's just make it really simple and understand that before we even achieve a rate of return, isn't it logically to think about that our money has to sit somewhere? And what better place to put money in where you cannot ever lose money and you have full access to money? It grows on a daily basis. Stock market doesn't impact the growth. Taxes don't impact the growth. And when you need money, it's always readily available. And if you can store money inside an entity like that, how much of your money you don't want residing in an entity like that? And from there, you can control the banking function as it relates to your needs. So if someone wants to achieve a 20% rate of return, to think about this, you can achieve that by taking policy loan and making it even better, enhancing the objective. All right, design of their system. So design of a system for the clients that we are going to talk about. So Andy, so there's two things. So one component is the premium, and the way the premium is structured is there's something called required premium, which is the insurance company needs. In Andy's case, is $42.62 per year. And then there's a deposit option, which is $13,438. The deposit option is optional. It's not required. So the insurance companies do not need that portion of premium, but that deposit option should not be optional to you, especially for the first 5 years in your policy, because that deposit option is building and getting the policy to point quicker where you can control the banking function even quicker and better. So required premium is what the insurance company needs. $13,438 is optional, but not optional for us. So total premium that Andy wants to put in is $17,700. His starting death benefit on the whole life insurance is $139,000. Now that's just the starting death benefit. The death benefit will compound every year. And as that benefit compounds every year, so will the cash value. Because cash value has to grow every day to match the death benefit by age 100. Now, this death benefit isn't enough on Andy because they have a high need for insurance. So to supplement the need for insurance, he ended up purchasing additional life insurance, $1.5 million in term insurance. God forbid something happens to him in the short-term basis. But buying that term insurance also gives him the option to buy or convert these term insurance policies to more whole life insurance, which is what he can use to perform a bigger banking function without even qualifying medically. So that's for Andy. Jackie, her minimum required is $3,992. The reason why it's a little bit lower for Jackie is because male versus female. And Jackie is a bit younger too, but biggest reason is male versus female. And her deposit option is $13,508. Total premium for her is $17,500. Her starting death benefit is $174,000, higher than Andy because Jackie is younger and being female, she gets a higher death benefit because females are low risk to the insurance company as compared to male. And then again, this was not enough for her to meet her need for insurance for the family. So she also purchased additional $1 million in term insurance just to cover some short-term loss in case something happens to her. So that's the individual system, but again, it's not an individual system that they're creating. These are family banking systems. So let's talk about what does the family system look like. So total minimum required premium, which is a combination of both of these, is $82.54. Total deposit option is $26,946. Total premium is $35,200. And then we'll talk about the source of premium. So the good thing about structuring the policy this way is because it gives you the most opportunity to grow your system in a quicker fashion, but it also gives you the opportunity for more flexibility because in case premium has to be reduced, the minimum required is $82.54. Maximum they can put in is $35,200. So there's flexibility built into the system from day one. All right, so let's talk about source of monies. So the monies for the premium came from their existing behavior of saving. They wanted to reallocate some monies that they're putting in investments to build this system first. They were already sitting on some cash, so they redirected that cash. So they didn't change the money, they just change where the money is sitting. So just by changing the address of the money, instead of sitting in a commercial bank, they just redirected that into their system. You're going to see just by that behavior, what would that look like for them going forward? And then obviously the process of becoming a banker is going to enhance even more. All right. So yeah, I think we touched base on this. So what's the duration? So let's talk about duration. So the total premium, so $17,700 for Andy, he plans to put that in for 5 years. And Jackie plans to put the full $17,500 for 5 years. This should not be $35,200 because Well, that's the total family system, 35,200, which they plan to put for 5 years. But then going forward, starting year 6, they're only going to put the minimum required premium in. So full 35,200 for the first 5 years for both of them. Then going forward, just the minimum required premium. They have the option to put 35,200 for the rest of the time, but this is how they want to approach it going forward. Bigger capitalization in the initial years, the first 5 years, and then they're okay reducing it going forward. All right, so you can see this is what's happening. So the first column is the year, so policy year. Second is the age, so Andy's age, Jackie's age. Then there's total premium, and then the last column is the cash value. I'm not showing what that happens to death benefit because of obviously the screen restrictions there, but I wanted to isolate the product from the process and focus on the process. So the full premium is coming in for the first 5 years, and starting year 6, as you can see, they want to reduce it down to minimum required, which is 82.54. And then going forward, it's just going to be minimum required. And they plan to put that minimum required until Andy reaches 65. So from year 1 all the way till year 15, that's the capitalization phase. Starting age 66 for Andy, year 17, they're not putting any premium from their pocket because the policy can go on its own at that time. That's another good thing where the system becomes self-sustainable. Now, I'm going to pick very specific years, and I'm kind of putting just trying to focus on the essence of the teaching points here. I don't want to show a whole bunch of numbers and just confuse our eyes. I just want to tailor a conversation to very specific things on the process here. So starting year 5, so they put all the way till year 5 the full premium of 35,200. But starting year 6, you can see they have reduced it down to minimum required premium of 82.54. The cash values up until year 5 were 181,065. Cash values at year 6 are 198,574. So the difference between year 6 and year 5, so the cash value growth from year 5 to year 6 is 17,509. And the premium that went in at year 6 is 82.54. So they put 82.54 and the cash value growth is 17,509 tax-free. And if they wanted to access that growth of 17,509, just that growth, they can access that growth without interrupting the growth because they can access policy loans. So here's an important fact that you have to recognize, and that important fact is non-negotiable because it is going to happen whether you do anything about it or not. You cannot actually do anything about it. 6 years from today, you're going to be 6 years older. That's a fact. The question is, 6 years from today, do you want to have the option of putting 82.54 into an account, which increases the account value by 17,509? That's option 1. Or option 2, you want to continue putting 82.54 in a commercial bank, and all you can spend is 82.54 from the commercial bank for the things that you want to use money for. Whereas with this, you put 82.54 and you get to spend $17,000. So 6 years from today, you are going to be 6 years older. Time is going to go by. Think about the last 6 years, how quickly it went. Well, the same thing is going to happen in the next 6 years. And you have choices to make, right? So at year 6, they put $1 into policy. The growth is $2.12. So think about this from another vantage point. If you have to put $1 into an alternate investment, doesn't matter what alternate investment, what rate of return will that alternate investment have to earn you net after taxes, net after fees, $2.12. Think about that. I know it's a lot. Whereas with this, cash value must grow to match the death benefit by age 100. It's not an investment. It's going to happen tax-free. So at year 6, you put a $1 in the policy, growth is $2.12. I picked another random year, year 9. The premium hasn't gone up, 82.54. That's the minimum premium. The cash value growth from year 8 to year 9 is 20,974. You're putting 82.54 in an account and it's grown by 20,974 tax-free. And again, I'm repeating myself. If you want to access the $20,000, just that growth, you can access that growth without interrupting the growth. At year 9, they put $1 into policy and the cash value growth is $2.54. Picked another year 14, 863. The one question that we get is, how long should I continue putting the money in? Well, you can let me know how long they should continue putting the money in now. Because at year 14, they put 82.54 as premium. The cash value growth from year 13 to year 14 is 25,161. They put $1 of premium at year 14, and the cash value growth is $3.04 tax-free. Again, rhetorical question. If you had to put $1 inside any alternate investment at year 14 from today, what rate of return that investment has to yield for it to be net $3 after taxes and fees? And not just that, you're able to access that investment without interrupting the growth of that investment. Something to think about. So at year 6, dollar into policy creates $2.12. At year 9, dollar into policy creates $2.54. At year 14, $1 into policy creates $3.04. Do you see a pattern that's happening here? And what's that pattern called? Share in the chat box. What's that pattern called? Dan, what are we getting?
Compounding.
Compounding. And access to money without interrupting the compounding is possible. And don't forget the death benefit, which is also there for good measure. Because there's two things that are going to happen 10 years from today, or any time going forward. Either you're going to be alive, or you're going to be gone. If you're alive, you'll have all the benefits of the policy to become your own banker. If you're gone, the family will have the death benefit. It's a win-win. Frequently asked question, who's contractually guaranteeing the cash value growth on a daily basis? Is it the policy owner, or is it the insurance company? So put A or B in the chat, and then let me know what comes up.
Okay, we're getting some 1A. We got some Bs. We got the insurance company, lots of Bs. We got another A, B, 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 mostly Bs.
Yeah.
But the odd A.
It's a contract owned by the policy owner, but the insurance company is on the hook to deliver all the contractual guarantees of cash value accumulation, cash value growth, because they're the one guaranteeing the cash value must grow to match the death benefit by age 100. All the risk to fulfill this contractual guarantee is with the insurance company. All policy owner has to do is make that deposit, and the policy owner will make that deposit no matter what in any institution. He just chooses, or they just chose in their case, to make the deposit in their system. So insurance company is the right answer. So how much tax is the policy owner paying on daily cash value accumulation? Are they paying tax on marginal tax rate, or they're paying zero taxes? Which is the right answer, A or B?
We're getting lots of Bs.
You're 100% right, B. Do you like zero taxes? If you like zero taxes, you're going to love the process of becoming a banker. Now, the stock market tanks. Does the cash value stop growing, or does the cash value go backwards? What happens to the cash value? Did the cash value stop growing? Yes. Or cash value, nothing happens to the cash value growth. So heck no. So the stock market tanks, what happens, A or B? So please share in the chat box, A or B.
Yeah, we're getting mostly all Bs, what I've seen here so far.
Absolutely. Again, I'm repeating myself. What happens in the financial entertainment world doesn't impact what happens inside the policy. That's a contract owned by the policy owner, contractually completed by the insurance company. The cash value must grow every day to match the death benefit by age 100. So I'm going to age 65. When Andy turns 65, Jackie is 60. They stop putting premium into policy. Here's the total premium that has gone into policy up until this point, $258,541, which includes the first 5 years of full capitalization of that $30,000, $35,000, and then minimum required premium after that of $82.54. So this is the total premium that's gone in. This is the cash value, $419,000 at age 65. Cash value, as you can see, started even $1,000 in premium and $419,000 in cash value growing daily tax-free. So think about this. If instead they chose to put $258,000 in an alternate investment, doesn't matter where, what rate of return will they have to earn in that investment to meet $419,000 after taxes, what the policy did, without even factoring in the death benefit? So if you take $258,000 and put into alternate investment, logic would say if the cash value is $419,000 and that's tax-free, an alternate investment value has to be $800,000 so they can net $400,000 after taxes. So imagine what rate of return and risk you have to take to put $258,000 to get $800,000 before taxes so that you can net $419,000. And by the way, that investment, the only way we can access money is by withdrawing it. And the moment you withdraw money from that investment, it reduces in value. If they want to access the $419,000, they can just access a policy loan, and all that $419,000 just continues to grow uninterrupted. When taxes go up, which they're going to go up, tax-free becomes even more valuable. So if you want to shield your wealth from future taxes or future tax increase, become your own banker. So let's talk about tax-free retirement, right? So all I've spoken so far is just what the policy did. We haven't even talked about the process of becoming a banker, but I just wanted to finish this train of thought and show you what the policy will give them from a retirement standpoint, and then we're going to get the becoming a banker process going for them. So tax retirements from age 70 till age 90 is when they want to access monies from the policy. So total premiums have gone in as $258,541, as I just showed you. Tax-free passive income, I shouldn't even call it income because it's just loans. They're spending debt. Because it is debt, you don't pay taxes on it. So if they have other sources of income at that time from the RSPs or pension plans or real estate, whatever it may be, those are going to be taxable. This is loan that they're spending every year, and this is non-taxable, which means this is not going to change their tax bracket. If this $22,000 per year was an income, not loan, that $22,000 will be added to their total income, and it may change their tax bracket completely. The only way for you to pay less taxes is just manage your tax brackets efficiently. And this does it beautifully. So they get $22,000 per year from age 70 to age 90, which is about $462,000 in income. Not income, sorry, loans, debt, tax-free. And when death occurs, I'm presuming that occurs at age 90, this is the net death benefit after the loans, because all this $462,000, the loan and interest loan of $462,000 and interest accrued on that, all that will be deducted from the death benefit at that time. And this is the remaining death benefit which the family receives tax-free. Because in their passive income time, as they're accessing these policies for access to capital as debt, they're not paying back any interest. They're not paying back any principal, and that's okay at that time because they're not practicing the process of becoming a banker at that time. They just open the tap to get access to all that money. But up until that point, they want to use these policies to recapture all their lifestyle, so they'll continue to replenish the capital. But the moment they reach 70, they're just opening the tap and then taking money out of the policy. So they put in $258,000. They were able to spend at retirement $462,000 tax-free, and the net death benefit payout is $635,000. So money in $258,000, money out $462,000. Also money out for next generation is $635,000. So imagine if you had to put this $258,000 into some other alternate investments, what rate of return the investment has to earn to give you this much in tax-free passive income and this much in a legacy. The math becomes mind-boggling now. Here's something interesting. If this $462,000 from age 70 to age 90 was not debt that they're spending, but it was income, imagine the taxes they have to pay on that $462,000 and what the net will be after that. And imagine how that's going to impact the tax bracket going forward. Because that $462,000 did nothing for them, didn't show up in any credit report, TransUnion, Equifax. It's just literally debt that they spend. The debt was paid at debt from the death benefit, and the family got the remaining $635,000, which they're going to be custodian of, because that $635,000 is a windfall for the kids to expand their program going forward. So far, I've just talked about all the great attributes of what happens if you just move the money into the policy. I haven't even talked about the process of becoming a banker. So now we're going to pivot And this conversation going forward is going to be on the process of becoming a banker. So the objective is, in less than 6 years of starting a policy or system of policies, they want to recapture all their monies that they're spending on all the things that they're buying, $160,000, because someone has to get that money. And they're sick and tired of paying interest. They're sick and tired of losing interest. They want to recapture it all. So let's see what that looks like now. So again, just bringing back to what they want to get accomplished. They want to have all the money, that $160,000 is going into all these things. They want to have that flow towards them and recaptured. That's the objective. All right, so the first 5 years in the policy, so now I'm just going back to the first 5 years. So they've been putting $35,000 every year for 5 years. By year 5, they have $181,000 in cash value, and I showed you everything what happens after year 5. So by year 5, the cash values are $181,000. All they need is $160,000 to fund their lifestyle for mortgage, cars, investments, donation, vacation, property tax, you name it. All that combined is $160,000. They have $181,000 in the policy. They need $160,000. The policy loan available at year 5, so which is 90% of $181,000. The policy loan is $162,000, which means they have accomplished their objective. They can access on Jan 1st $160,000 as a loan from the insurance company, run all their annual expenses from using insurance company's money, and then whatever they're going to pay to someone else, they just redirected all that money back to them. So they're able to recapture all their lifestyle, starting less than year 6, starting year 5. Now here's how the transaction works. So recapture money and create a financial tailwind. We've been talking about this. You're going to see that real time now. So loan taken at year 5 is $160,000. Loan repaid from year 5 to year 6 is $176,000. That's with the interest that they want to pay back. So they paid back $176,000. Cash value at year 6. So when they repaid that loan back $176,000, because the cash value kept increasing from year 5 to year 6 and beyond, because policy loan never interrupted the growth of the capital. Policy loan doesn't impact your dividends. Policy loan doesn't impact your growth of your death benefit. Everything is uninterrupted. So cash values at year 6 are $198,574. They paid back principal and interest of $176,000. They can access $198,000 the moment that money is repaid. They can access more than what they repaid. Here's an analysis. Loan repaid $176,000, cash value at year 6, $198,574. $1 of repayment created $1.12 of access. They have 12% more than what they paid back. Where else are you paying your loans and creating 12% access to more money without even taking any risk on any investment, because all they're doing is banking? Just by controlling the banking function, they're creating 12% more just by doing that. How much risk do you have to take to earn 12% on your money today after taxes? Think about this. For things that you are purchasing now, how many of those dollars you can re-access? I know the answer. I want to talk a little bit about economic value add. So Dan mentioned beautifully in the grocery store example, the objective of starting any business is to be profitable. Banking is a business, and the intention has to be to generate a profit. For who? For yourself, for your kids, for your generations to come, so that you can have more to do all the 4 things when it comes to money, which is saving, investing, spending, and giving. So annual policy loan repayment is, annual policy loan that's required is $160,000. They repaid $176,000. Here's an interesting fact. Insurance company charged them an interest of 6.5% on that loan, because that loan was insurance company's money, not their money. Insurance company charged 6.5%. 6.5% is $10,400. But they decided to pay back at 10%, which is $16,000, because their behavior in becoming your own banker is far greater than the behavior of insurance company. You can't control someone else's behavior. The only behavior you can control is yours. So if you're selling the can of peas for 60 cents, well, don't sell for 60 cents, sell for 62 cents. Because with that extra 2 cents, you're adding economic value to your own business going forward. So the business becomes stronger, more profitable, more lucrative for everything that I just described. So the extra interest between 10,400, which the insurance company calls for, and the 16,000, that's $5,600. That's not extra interest that they're paying. Insurance company is only going to accept 6.5% in interest. So that 5,600 actually went as extra premium. And the moment it went as extra premium, it purchased more death benefit, which would produce more cash value growth, contractually guaranteed. It also produced more dividend. So everything became a snowball, even bigger snowball going forward now by just rethinking their thinking and becoming an honest banker. Because money has to flow at a cost. And the cost that they wanted to be profitable on as a banker was 10%. And let's see the impact of that now going forward. So again, grocery store example. Insurance company costs of 57 cents. Sorry, insurance company cost was 60 cents. Don't pay 60 cents, pay 62 cents so that you can buy more cans of peas and sell it to more captive customers and produce more profit. It's as simple as that. So the 5,600 went as extra premium. So when they pay deposit, because remember, premium is not a cost, premium is the solution to the problem. Bigger the problem, bigger the solution, bigger the premium. So when they pay extra cost of 5,600 as premium every year from year 6 till year 15, because that's when they started taking policy loans, right? And then all the way till year 65, the total extra 5,600 per year is for 10 years is $56,000. The cash value now at age 70, which they started taking passive income at age 70, the cash value now is $625,000. Without putting this extra capital in, the cash value at age 70, which was just based on the initial premium and then reducing the premium, not really paying back at 10%, none of that. The cash value at age 70 at that time was $551,225. So think about the impact that they just created. 56,000 of extra capital created 74,760 tax-free of extra use of capital going forward. That is literally what happened. Now, this 74,760 is just extra at age 70, but it doesn't mean that this is what they created extra. Because at age 70, the 625,000 that they have, it just is now compounding based on 625,875, which means it's going to become a bigger number. Whereas without doing any of this stuff, all they had was $551,000, and it'll only compound at $550,000. So they created extra access and extra growth in the capital. Now I'll come back to the retirement. So retirement income tax-free without extra 5,600 per year for 10 years, it was 22,000 a year from age 70 to age 90. Total was 462,000. That benefit, 635,000 net after paying all the loans and interest. Retirement, after putting that extra interest in, economic value add. So they decided to pay back at 10% instead of whatever the insurance company calls for. So from age 70 to age 90, the extra retirement cash flow tax-free that they have is 26,500, not 22,000 now. So the total extra that they spend now is $556,500, not just $462,000. And the extra death benefit is, so new number is $756,000. It was $635,000 before. So they spend extra $94,400. Remember when we looked at, based on the extra money putting in the 5,600 for 10 years at age 70, they would have had 74,000 extra just as cash value. And I'd say because that extra is cash value, the money is going to compound from there onwards. That's exactly what happened because that money compounds from there onwards, which is why they were able to spend more in retirement time going forward. So the extra cash flow is 94,400 above and beyond what would have happened if they had just bought a policy. But again, buying a policy and performing a function called banking are two different things. Economic value add to your future comes from performing the banking function. The death benefit increased by 121,000. So for extra 56,000, they created 94,400 extra in cash flow. They created 121,000 extra in estate value. That's extra. So here's a question now, based on what I just walked you through. And Dan, if you can help me with this, please list all the disadvantages of putting more capital into your system.
All right. We got an absolutely none. We got none. Got
That's the right
nothing.
answer.
0. LOL. I like that one.
Yeah, I like it too.
Zilch.
So here's the thing. There's cost of doing, and there's also a cost of doing nothing, because both options are available. You can do something with it, or you can choose to do nothing with it. And there's cost of doing, and there's cost of not doing. And I want you to have a clear picture of both costs. Let's look at those costs for Andy and Jackie. So cost of not doing, which is the conventional way, which is you don't become your own banker. You just keep doing things the way you are. So from age 50 to late 65, they would have still used all that $160,000 per year to buy the things that they want to buy. Remember the 4 things that they were spending money on. They were saving, they were investing, they were buying, they were spending it on things that they want to buy, and they were giving it away as donations. So if they don't do anything but becoming a banker, they're just going to do what they wanted to do, which is spend all that $160,000 from age 50 to late 65. And the cost of doing that is $160,000 per year for the next 15 years, which is $2.4 million. You just don't see it as a cost because nobody has ever shown you things this way. That's the cost of doing all that, $2.4 million. I'm not even factoring in the cost of lost opportunity, this straight transaction. This is what happened. Money left them for all the things that they want to buy per year, $160,000 per year for next 15 years. And cost of doing nothing is resulted in some outcomes. So the conventional way, not becoming a banker, the cost is $2.4 million. We're looking at time period from age 50 to age 65. What they accomplish is they accomplish exactly what they want to accomplish. They were able to pay for mortgage, cars, they were able to buy investments, living expenses, they were able to put money into savings, donations. So they continue doing what they want to do. So they accomplished that, which is great. But the cost of accomplishing all that is $2.4 million. This is the cost of not doing anything. Now let's look at the cost of doing. Now, in addition to what else they have, well, they don't have anything else because that's basically what they did, right? So cost of doing. So obviously premium. I'm not going to factor. I should not be factoring in a premium because that's the capital to build a business, a system. But let's do that. So premium from age 50 to age 65. I'm going to consider that as a cost. Interest paid on policy loans because from age 55 to age 65, they were recapturing all that money. They were putting almost 10% interest, which is $16,000 of interest payment on the policy itself. So we'll factor that in as a cost. And then they didn't start using the policy until age 55 because they were building for the first 5 years. So from age 50 to age 55, they still had to run their life. So they still paid that $160,000 per year to do all the things that they want to do from their pocket, and that money just left them. So I'm going to factor in that cost also. So the money spent from age 50 to age 55, and after that, they just use the system to recapture it. So let's look at all the costs. So total premium is $312,000. And that is factoring in the extra interest that they paid, which went in as extra premium. That's $5,600. Interest paid on policy loans, $160,000. It should be less than this because I'm factoring in the 10% because insurance company is calling for 6.5%. They're paying back 10%. The difference between 6 and 10% is going in an extra premium. This should have been low, but I'm going to keep it really simple. Let's just say that's the interest. That's the cost of doing business. Money spent. So from age 50 to age 55, until this implemented the process of becoming a banker, because they were just building the system, they still had to do what they had to do. So they spend $160,000 every year for all the things that they want to buy for the next 5 years, which is $800,000. So cost of doing is $1.27 million. That's the cost of doing. And then cost of doing, help them recapture everything. Because they were working in an interest recapture environment, they had more money, and hence the overall cost was less to do. So cost of doing, 1.2 million, same time period, age 50 to age 65. They just didn't accomplish having money available for all the things that they want to spend money on: mortgage, car, investment, living, donations, savings. But they also created extra passive income going forward of 556,000 plus an additional estate value of 756,000. This is extra that they created. So by becoming their own banker, they didn't compromise on their lifestyle, their objectives. In fact, they enhance everything going forward just by changing how they're going to go about accomplishing the objective, because they have additional capital and additional estate value going forward. So if you analyze both methods, the first one is a conventional method. Cost is 2.4 million. Better way is 1.2 million. Time period is the same, 50 to 865. Both methods got them all these things accomplished, but becoming a banker enhanced everything going forward for them, because it created additional access to capital, which they use for passive income, and additional tax-free estate value, which wouldn't have happened without the process. So recapture and trust to create a financial tailwind. Remember I said this earlier, when a flight has a tailwind, it reaches the destination quicker with less fuel and less cost and more profit. And the example that I just walked you through proves it. The cost of doing was cheaper than the cost of not doing. And with cost of doing, they also created additional profits. In addition to above, which was just materialistic things that I just walked you through, which was money and the use of money. Let's not forget about all the emotional things that they got to accomplish. So I showed this earlier, so that you can share with me if the objective was met, which is more of certain things and less of certain things. So they wanted more of financial control, more of cash flow, more of liquid access, more consistent growth, more increased savings, more increase in asset protection, more enhanced retirement planning, more financial security, more predictable outcomes, more financial independence, less of loss of capital, less interest payments, less tax burden, less financial surprises, less of restriction to access capital, less interest rate risk, less exposure to market volatility. They wanted to fix the loss of control, less of your fees and penalties, and less of financial complication. So you can let me know in the chat box if they were able to accomplish this objective, because these are the objectives that the clients come up with. Money is just a materialistic thing, but in reality, this is what they want to get accomplished. So becoming a banker can be accomplished, as you saw, with not changing your cash flow. They didn't change their cash flow. They had a goal, an intention, and a motivation to get there. Without changing their objective, they didn't change their objective. They wanted to access all the money to do the things that they want to do, 160,000 per year. They're not working any harder. They never lost control over their money. This is what also got them accomplished. None of these things happen. So again, if you're in the US or you're in Canada, all you have to do is text the word schedule, if in Canada, 780-809-4599, and text the word schedule, if in the US, to 813-793-7921, and reserve a day and time that works best for you. And when we meet with you, we connect with you, we'll give you these more very specific case studies. Because right now I just showed you recapturing everything, but you may say, okay, I want to focus with starting with recapturing my mortgage. I want to focus with starting with enhancing my investment. I want to focus by recapturing all my debt. I want to have some more reading material. So this package includes all that. So give you more insight into what specifically can be done, because our solutions are not a solution. It's a tailored solution to your objective. So if you're thinking I should do this or I should not do this, let me just be very upfront and share with you. You're not in a position right now to even make this decision. Here's the reason why. Because you need to make this decision with confidence. Confidently, if you want to you should confidently make a decision if this is something you want to do. And here's where confidence comes in. Confidence will only come in when you have clarity on how this can work for you. Because clarity creates confidence. And when you have confidence, you can logically make a decision on it. And decision is yes or decision is no. And both decisions are acceptable, because at least now you're making it with logic, followed with confidence, followed with clarity. So simple three-step process for full clarity. So schedule the call. It's 30 minutes. We'll give you more gift as part of our promise to you, which is the Wealth Accelerator package. We'll get to know you better. Then we'll take a deeper dive into how we can add value to what you want to get accomplished, because everybody's situation is different. You may be doing this individually. You may be a business owner. You want to have discussion on how this can work for you individually and for the business wise. Everybody's different. Everybody's goals are different. Hence, we take a deeper dive into understanding how we can add value. And if he can add value, we'll let you know we can add value. And the last step is, after we've understood how we can add value, we're going to do a presentation on how and what your family banking system looks like. How is it going to work? What is our relationship going to look like going forward? Because you are not alone in this journey. You're going to have a designated coach who's going to be there every step of the way, strategizing with you. So one thing that people get from us is they don't just get one individual coach. You get actually the whole team, which is about 50 people plus. And we're adding more team members by the month. So after the presentation that's when you can truly make a decision, because at that time you can make a very logical decision to proceed. So through this process, there's no commitment, there's nothing. It's just us adding value to see where we can add value, and also for you to determine if we are going to be a good fit for you, and vice versa. Because our relationship is not transactional. It's not about, here's a policy, hope you get there, call us in 10 years. That's not what we do. We work with you on the execution of the process, because this is new to you. Every person that you meet with, they have implemented this process in their lives, and they have done this. And they've experienced doing this for several hundred people already. Okay, so book your clarity call. That's a beautiful name for it. It's a clarity call. That's what it is. So in Canada, text the word schedule to 780-809-4599. If in the US, text the word schedule to 813-793-7921. And maybe we can open the session for some group Q&A. Or let's do a value check. Dan, should we start there?
Yeah, let's start there.
If you want to do that, I'm going to drink some water.
All right. So just want to do a value check-in. So I appreciate the fact that you invested some time just to hear what we had to share today. And I just want to know, from a scale of 1 to 10, meaning 10, I got lots of value. 1, I wish that I was outside playing golf or something else. Just put those numbers in the chat box and just give us feedback on what you found for value today. All right. Thanks for all that feedback. We got a lot of 10s and more, and some 8s and stuff. So I think people found that we give them good value, Servlo.
One person
Excellent.
said 10, and now I'm going to go play golf. So are we. I got to tee off at 2:15. So.
Yeah. Good to see you've joined us today, Jessica. Good to know you're here. Yeah, we get the privilege of working with people that have implemented this in their life, and they're starting to see exactly what you walk through, the difference it's going to make in their life. Q&A. So now's your chance.
Do you want to have the team then just to help us with some Q&A? So
Exactly. Yeah.
Our amazing colleagues, if you want to just turn on your videos and just come join us. Thank you so much for just helping with the chat and Q&A in the back end. I know a lot of questions may got input in the Q&A, and I see that a lot of those questions have been answered. But I would invite everybody to be here, join us on the Q&A. This is the best Q&A panel ever, because we are the best at this in North America.
All right. So help us, team. What kind of questions we get that you think we should review with everyone today? No questions, I guess.
Crystal clear.
Crystal clear.
Well, the team did such a good job answering all the questions as we went, but I don't mean to laugh. I got a little humor out of one of the questions I just answered. I missed the name. I already dismissed it or responded, but he said, he goes, yeah, I'm just curious, like, why are banks not teaching people or this concept or promoting this concept? I said, good. I'm thinking, well, we're coaching people to get the money out of the banks and have more control over it. So,
Well, you can list all the advantages of bank actually teaching this process to the depositors. How is it going to impact the banking business for all the banks? Go up.
yeah,
You're doing exactly the thing that we don't want to teach is to have more money with the banks.
yeah, at the end of the day, we're still using the bank for the convenience of debit. So, we're still flowing cash through their system. It's just going to be the life insurance company's cash instead of yours. Yours is going to work hard in your system instead.
Well, it's simple, right? If you see a
Brian
advantage,
Rose. Shout out Brian Rose.
if you see an advantage in recapturing the interest environment and resulting in more for you to use and more for the next generation, then it has to be done outside of the banking system.
I do have a question from Bev that in the chat. It's so this is all great if you have extra income. How can you benefit if living check to check? Vern, did you want to speak to that a little bit?
Yeah, I've been there. In fact, I just saw the coolest I saw the coolest thumbnail on YouTube, man. I have to show you guys. If you didn't see that one, Andrew, you are awesome, or whoever created that thumbnail. It's hilarious. But I've been there. I've been there. And everybody probably on this team, I dare to say, have been there, right? And so we run into people all the time who are, everybody's in a different financial situation, and especially in today's day and age, not everybody has, a ton of cash just lying around that they can redeploy or what have you. So, this all begins with the way that you think. It all begins with behavior. It all begins with your priorities and what are important to you. So it's like Nelson would say that everybody's already spending all financial resources on what he or she thinks is best. So there has to be some honest introspection at this point. Page 65 of Nelson's book, and just really taking a deep dive into your spending patterns, taking a deep dive into where your money's currently flowing, where is your money residing. And this is part of what we do is we, examine exactly how you're structured financially and what your priorities are. And sometimes it sounds kind of silly to say it this way, but you can kind of find money. Because my friend Richard Canfield, a great colleague of ours, he always refers to a financial junk drawer. Every Canadian has a financial junk drawer. And that means you have, $1,200 in a lira over here that you never, from a past job. You got a few $100 or a couple thousand in an RSP. You got some in a TFSA somewhere, so we want to gather all those resources and see if we can redeploy some of that into your system. But with all that said, if things are really, just really that tight, sometimes, again, it's just what is really important to you. Sometimes it's a little uncomfortable, but you might have to either, find ways to create some more income, get a different job, or maybe a side job, or what ultimately my thinking is whatever it takes, right? Because if your desire is to get out of financial prison and you have a burning passion for it, you'll do whatever it takes to get started. And we're here to help.
Great answer, Vern. And the other question I just wanted to ask people now, we got a chance. So just put it in the chat box. Who's all opted in to get the free wealth accumulator package? Who's taken advantage of that opportunity today? Hey, we got some good answers. Great. Thanks for doing that. Thanks for opting in. That's great information to help you expand your knowledge when it comes to this concept. And Roman, tell us about who you've got listed there as the top 3 so far.
Then, yeah, we're trying to figure out.
Okay.
We know 2 names now. We're trying to figure out the 3rd name right now. Just give us a couple seconds, I guess. Yeah.
All right.
So
Thanks.
we have top 4 right now. I'm gonna put it in the chat. Just give me one quick second.
Thanks, Roman. So just so you know, so if you get to be one of those names, we're going to have it, and then we're going to reach out to you if we don't have your address so that we can, Serval and I are going to send you that book. And so you can expect to hear from us over the next week, and we'll know where to send the book.
Hey, Henry, I'd love to hear your response to that question that you're answering or that you just answered.
Which one?
The skeptical one.
Oh, well, the question was, why are people skeptical about whole life insurance? My answer to that question was, if you were told to eat a healthy meal, why do people not eat a healthy meal? That's how obvious it is for me.
Yeah, well said.
Yeah, that's exactly right. You know, people make choices. They know they should eat healthy, but a lot of people still choose not to eat healthy. So you get a choice. What other questions we got?
Well, at the end of the day, I just want to expand on that too, Dan, because somebody had mentioned earlier, I can't specifically remember, but it was just, more geared toward a life insurance idea, something about life insurance. And then same with this, like, why are people skeptical about whole life insurance? Again, I mean, obviously we're huge advocates of whole life insurance here. Like, if you take 2 minutes to discover or to determine, research how the tool actually works and the track record that it has, it's kind of a no-brainer. But that's besides the point. We're talking about a process here. So somebody asked earlier, hey, this is great. Does this work in Asia or Europe or wherever? And my response was, yeah, the process can work anywhere, right? Because it's a process. Now, whether or not they have the best tool for the job that we're lucky enough to have, that the best tool that we've been able to find, which is dividend paying participating whole life insurance, obviously structured the appropriate way and so on. I can't answer that question. Some places have it, some places don't. Obviously, North America has the right tool, but that's what it is at the end of the day. It's like I always joke with people and say you can get out in your hands and knees and use a pair of scissors to cut your grass, but you'd probably want to have a better tool. So the objective is to cut your grass. The objective here is to implement the process of becoming your own banker, and you don't need a life insurance policy to do it. It's just that the policies, the way that we structure them, it's the best tool to actually implement the process. So something to think about.
Yeah, one thing, thank you, Warren. One thing that's a hedge against skepticism is clarity. There's nothing new about the whole life policy that we're sharing today. It has been the way it has been since 1847. I'll repeat, it has been the way it is since 1847. What we're sharing with you is the opportunity that it relates to using this tool to implement the process. Whole life has nothing to do with the process called banking. It's just the best tool. If you want to implement the process, this is the best tool to get the job done. Remember, you have to create a financial tailwind, because then you can get to your destination quicker, cheaper, and with more profits. Would you like that? This is the tool that'll do all that for you.
Hey, Sarbel, can we chat briefly about how this process encourages conversations within the house? Because I continue today, I probably saw 4 comments or questions about why isn't this taught in school?
Yeah.
And I got to tell you, my ears are steaming.
Yeah. Well, who controls what's taught in the school? Dan's
Exactly.
the video that Dan played, doesn't that answer all the question on what's happening?
Exactly. So we got to stop relying on the school system. God bless teachers. This isn't a shot at teachers or anything like that. I'm just saying we got to stop relying on the school system to teach our kids about nutrition and money and life and all these things. It's all about having those conversations in the home. That's what we've been trained to do over the last 150 years, is abdicate these responsibilities and these opportunities to other systems. We got to take control of this stuff, guys. That's what it's all about, is encouraging these conversations with our family, in our home, and educating our kids on our values and what matters to us, and how to keep that money in the house, and how to have good conversations about, like, what's going to happen to grandma? What's the plan, right? We've actually had a conversation about it, and we get the weirdness out of that conversation. There's nothing weird about it. You know what's weird and uncomfortable is when somebody dies without a plan.
Exactly.
Dan, what's the great quote from Bob Shields?
Which one? You don't have to die to
Remember?
win.
No, I wish everybody could die
Oh,
for
yeah.
a week so that they know what kind of a mess they leave behind. So we got
100%.
to start having these conversations so that we're actually empowered about it and we can sleep at night, not always have that weirdness in the background and we're worried about it, right?
Yeah. So well said, Vern.
Jason, anything to add to the amazing attendees today?
I think everything's been said. Are there any questions that you want my help with?
Well, maybe you can speak to the fact that, booking that clarification call, the importance of it, because you discovered this process by actually taking an action. And because you discovered this process, everybody here is able to teach this process, and we are able to serve 3,000 clients a year because of the decision that you made.
Exactly.
Yeah, you know what I would say to everybody is that I haven't ever been able to find or uncover a disadvantage to having a clarity call. Because that's the whole purpose of having the call, is to get to clarity. And so there isn't a disadvantage to that. And as it's been mentioned, I mean, the investment to do that is an investment of your time. And we can say with absolute clarity that it'll be a valuable use of your time. And having practiced this process now for so many years, this journey began in July of 2008 for me and for my family. And we hear from people all the time who say things like, I wish I would have discovered this 10 years ago, 5 years ago, 15 years ago, insert time frame here. And our response is always the same. You can't say that 5 years, 10 years, 15 years from now. You've learned about it now. And you're going to need the use of money for the rest of your lifetime. You know, I had a gentleman ask one of our teammates who was interviewing me yesterday, one of the questions that came up is, am I ever too old to start implementing this concept? And the answer is, are you ever too old to not need the use of money? Right? There's no cap there. So no, you're never too old to start. And that's why getting a clarity conversation going with the right person on our team, as Sarblo mentioned earlier in the boot camp, that all of our practitioners being authorized with the Nelson Nash Institute, the degree of training, mentoring, coaching, and support that all of our teammates receive is one thing. But when you choose to work with a practitioner on our team, you get our entire team. And so that is capability multiplied to the degree where no other team, to my knowledge, can match. And believe me, there are many, many great practitioners out there, and we tip our hats to them, and we wish them continued success. But for those people who are attracted to us, who say you're exactly what we're looking for, when you work with one of our team members, you get our whole team, and that's an advantage that we can't put a price tag on.